Okay. And Kat, you are back on my PowerPoint slide, correct?
Yes, I am.
Okay. Welcome to episode 3 of Shift Happens, guys. I've titled this one Stymied by the Stimulus. I'm going to go ahead and preface this with it's not all good news, but it's honest and it's for your benefit. And the whole first part of this is going to be stuff that just kind of sets the stage for what I think a lot of people don't fully understand. I've been on the phone with lenders. I've been on the phone with people who own and founded more companies. A lot of stuff has happened over the weekend. A lot of the stuff is continuing to happen. And I figure this has been a real struggle for me. I don't want to be an alarmist. I don't want you guys to get freaked out by what I'm going to cover today. I am very interested in being part of the solution to help you get through this. And the biggest problem I've been seeing since our last session is deals falling apart at the table. So I called an audible here and I want to talk about lending today. And I want to talk about the challenges that you're not necessarily hearing about in the news and you're not necessarily hearing about from the loan officers, the people on the ground, because communication is not flowing down to all the right people. So I've had to coach some people how to creatively keep deals together at the closing table in order to get their sellers out and to get the buyers what they wanted to market moving forward. So my intent here today is not to spread bad news or alarm anybody. I'm a bit of a geek and I'll show you a little bit what I mean about that. I'm going to back it up with data. So that's my preface. Like, I've got your back. If you don't understand this stuff and you need help putting deals together, we have coaches on staff and we can help. I think the highest and best use of my geekishness and all the things that I study behind the curtain is showing you how you can keep the deals you have right now moving forward. And you can actually, even as this market continues to shift underneath of us, how you can actually stay competitive in a market where supply and demand is being tilted by forces outside of our control. So I'm going to run through this fairly quickly. We only have an hour today. I have probate mastery at 2 p.m. Eastern, so I've got to run through this. Just so you kind of understand who I am as an investor and as a realtor. In 2008, I think we pulled some levers that set some things in action that we're now dealing with. And those have been hiding in our economy. We like to point at the stock market and the real estate market because those are good news indicators. But the real economy is a lot broader than that. And as you see in these two charts, this is from the St. Louis Federal Reserve. We had around $2 trillion in aid, we'll call it, to get us out of 2008. In 2016, our actual debt passed our GDP, our gross domestic product, our public debt. This isn't our government debt. So this is what made me nervous. Change investment strategy. Around 2016, I sold all the real estate I was holding, and I started taking shorter term and making shorter term investments like private mortgages, or I bought long term recession proof assets like I buy through good sponsors. I buy syndications of mobile homes and self-storage. Those are things that when I back test through 2008 and an investment from an investment perspective, those are things that I think will fare well in the economy that I feel like we could be coming into. So I'm so convinced about this. I've studied it so much that I was willing to take massive financial risk based on my opinion while everyone was telling me that I was wrong. So you can kind of see in these charts where this has happened. And the Federal Reserve did a lot of things to get us through 2008. We're doing way more things right now. But unless you understand how it's going to change the markets that are well above you, I don't think you can quite be prepared to react to it. And what I don't want to see is anyone on this call get blindsided. So I'm going to show you some truth that's kind of uncomfortable, and then we'll talk about solutions. So I have been bullish on single family homes, especially in the residential niche, just because Americans are at healthy debt levels on housing. Finally, we deleveraged in 08, and now we're only spending 16% on owning. Renters are spending 35% plus on average. So I've been talking to a lot of people about this. I didn't know what the trigger would be that would set all this off, but these underlying economics made me very nervous and changed the way I invested. And because I think I understand it, and maybe I don't. I'm certainly not the smartest guy in the world. When most guys are watching sports, I'm studying finance. So I think that my highest and best use is to tell you what I see and then show you how none of us can change it. I can't influence it, but what I can do is react to it, and I can help others. So what we're going to cover, everything in orange is stuff we've already covered. Today, we're going to look at the current state of the lending markets and how you can react accordingly to protect yourself and your clients. And then eventually we'll get to operations and talk about buyer business, seller business. I just feel like this is more urgent. So we're going to talk about the STEM details. We're going to look at lending, and we're going to talk about what you can do for your buyers and sellers. So if you haven't read the 880-page bill, neither have I. I read a summary. I tried to read the whole bill, and I just thought there was a better use of my time. We'll look at this kind of first from our selfish real estate perspective. Things that are good for real estate is they're now going to be sending checks and this will probably be in a 2 to 3 week window. As long as your earnings are under $75,000 as a single filer or $150,000 joint, you will get a $1,200 check. For the first time, I believe ever in history, we've extended state unemployment benefits from 26 to 39 weeks. So what this tells me is the government's pretty certain that we're going to see 9 months of pretty high unemployment. Unemployment insurance was also extended to gig workers and independent contractors and self-employed individuals. This is huge news for our industry. This will make a difference. This is a bailout that we missed in 2008. So congrats to everybody on here, because I think pretty much everybody on this call falls into that category. In addition to, the problem is the really successful people on the call, we're kind of left out in the cold, right? People, if you're doing over $150,000 AGI, then hopefully you have good saving habits, because right now we don't see that bailout. In addition to the UI benefits, the Fed is stacking on an additional $600 per week. Now, a lot of the details of how you're getting this, when you're getting this, are still being worked out, but the wheels are now in motion. It has been signed to law. So, and now you can access it up to $100,000. You can essentially loan yourself $1,000 for 3 years, interest-free without any penalties from your retirement account. So if you have 401ks or solo 401ks, IRAs, you could consider, if you're doing this, make sure you understand it's investing, not spending money. But this is really good news, especially for the people who won't get the stimulus checks, but they have been saving, they have been investing in retirement accounts. This gives us some personal liquidity so we can invest for ourselves. The things that I see that are bad in this for real estate is mainly the uncertainty around default. We've got at least a 6-month forbearance on mortgages. So in theory, this is to protect the market from default, so a bunch of foreclosures don't rush through. But I think the unintended consequence that they're now trying to sort through, and what they're dealing with this week, is if you're an investor and you knew that it was more likelihood than not that the person who originated their mortgage wouldn't pay because they don't have to, how much would you pay for that mortgage, or would you say pass? And those are some of the unintended consequences that has caused so much trouble in the secondary and capital markets. And we'll look at that in a little bit of detail a little later. But it's already disrupted part of the mortgage markets. On Friday, I was coaching people who couldn't get jumbo loans closed, and we were scrambling to go to community banks to try to get portfolio paper, or to quickly teach the seller how they could write a second mortgage and knock that buy to a conventional loan where they could still get qualified, and then the seller can carry a second to make the spread, so they can go ahead and close the deal that they have. So this is something that it really made me look at what's actually happening. And I think a lot of this is just nervousness from investors in the capital markets, because nobody knows what this looks like. Nobody has ever, have never been held accountable for their financial commitments for such a long So it's the nervousness is causing problems that I don't think I really do believe they did this with the best of intent, trying to help everybody. Um, the problem is it's causing some specific problems in real estate lending that I don't know that this is a giant complex economy, and there's nothing they can do is gonna serve everybody. So the good news is they're throwing whatever they can at it, and I think that they're gonna step up on solutions. The forbearance of rents, this is gonna hurt as far as clearing these assets when they do default. Personally, I had a lot of stuff under letter of intent and contract in multifamily because we changed strategies, and we found a way through working with local housing authorities to partner with them in these small markets where they're still renting way under market. We could partner with the housing authority, bring those up and make sense of it. Even in this the environment 3 weeks ago. But now I can't, I don't know what an apartment building is worth. What's a 100-unit apartment building worth if you have leverage on it, and you're not getting rent, and you can't evict, you can't clear your asset? What's it worth? And that's something that there's a lot of uncertainty in the investor community right now. A lot of guys have a lot of cash, but they're not sure where to put it. And that's something that's challenging. This bill basically formalizes their nervousness. So there's some strong headwinds that we're going to have to overcome, and I certainly don't have all the answers right now. I think daily it becomes a little bit more clear. But this is what the stimulus did. I mean, it shored up life for a lot of people, but it did create some unintended challenges in real estate that we're going to have to face. I'm going to go through this one pretty quick. What's happening in the secondary market? I don't understand just in a few minutes or less. When somebody originates a loan, so your client goes out and makes an application, they have to meet a certain set of standards, what we call underwriting standards or qualification standards, in order for that lender to close on the loan. And that's why we have all the paperwork. A lot of real estate professionals don't really understand the industry past that point. What happened I won't get into 2008. What happened in 2008 is happened all over again. We've just been more quick to react and stabilize it. But when that loan gets closed, then it sits on the lender's books, the originator's books, for a little while. Sometimes it's a day, sometimes it's a month, and it gets packaged up and sold up into the secondary market. That secondary market is made of investors in capital markets. They will buy these mortgages, package them together, turn them into securities called mortgage-backed securities, and then those are sold to pension funds, endowment funds, union retirement accounts, big buyers that have to move a lot of money in safe assets. Traditionally, these have been safe assets. The problem now is when a lender originates a loan, they're only making 30 basis points. So when they sell that loan, they have to sell most of the profits. That interest is sold up to the secondary market. So they're only making 30 basis points on the actual paper that they originated. But they keep the relationship with the borrower, and they manage that. What's happening is any loan that was written in the last 3 years not into a profitable phase. So when the news, everyone else told everyone to go refinance everything because interest rates were going to zero, that misinformation flooded the banks, choked them on refi applications, and then they were refinancing loans that they had originated less than 3 years ago. So they were literally losing money doing business with their customers. And that created a big surprise for everybody. And a lot of people in the secondary market said, whoa, we don't know what's going on. So in short, if you look at this chart, you can, on the left, you can see how this happened. This is basically the stress index of the financial market behind the curtains. And you can see in 2008 how that happened. And then it stabilized, and we've had a pretty good run. If you look all the way to the right of this, there's a big line heading for the moon. And then this on the right is just zoomed in at that. This is I think a 30-day look versus this all-time look. So you can see this is the uncertainty. This is a graph that shows you the uncertainty that the people buying the mortgages and making mortgage-backed securities so the Fed can put them on their balance sheet. This is how they're feeling right now. And this is why there's so much uncertainty in finance markets. And I think that not Many people understand it. And if you're going to ask your seller to do something like carry a second mortgage and take on risk, then I think I have to show you this, because you have to be able to explain it to your clients in an intelligent way so you have credibility. So this isn't to scare you or tell you the world's ending. It's to tell you the world's changing. And I'm going to try to do my best to show you how you can step up and meet the challenge with a smile on your face. So government-backed loans have not yet changed their underwriting standards. Right now, Fannie, Freddie, VA, FHA, USDA, those loans still have the same standards. However, most people believe that the rates will go up because of this uncertainty. It's going to the investors, to get them to move, just like to get one of your buyers to move, we have to make lower rates to make it more attractive to rush in, right? Well, for these guys, for them to take more risk, to rush into that risk, you have to give them more reward. So I pulled this from Bankrate on the right. I looked, and each day they do a report on this, and they survey thousands of lenders across the country. This one was on Friday, I believe. So 50% of lenders think that rates will stay the same. 17% think they'll go lower. 33% think they will go up. I'll tell you that I'm in the camp with 33%. I think because of what I understand about the markets, I expect rates actually will go up. So I don't know how long. They will go up until the Fed comes up with a solution for some of these problems we're talking about. I expect credit score minimums to rise. Right now, you can still originate some loans with as low as a 520 credit score. Don't count on that for too much longer. Your debt to income threshold, I think now you can go up to 43%. I would expect that to tighten. They're going to make sure that people can repay the debt. And then some loans are going to temporarily disappear. The ones I'm seeing going already, and this isn't across the board, there are some lenders who can still write jumbo loans. They're just getting very few and far between. So jumbo loans, non-conforming, like any of the no doc, low doc, self-employment loans that were coming back into the marketplace, those are gone. Poof, they dissolved. Second homes are going to get challenging, vacation homes, and condos I expect to get challenging. I have not seen this so much. In 2008, this was the first thing to go. By around July, they pulled all of our condo products. We had over $150 million in commitments from Wells Fargo, GMAC, and Countrywide, and they all ripped them away on the same day. And I expect that that's going to be one of those moves. So if you have assets under contract in these classes, if you're in vacation homes, if you have luxury homes, or if you have condos, this is important, because it's likely when you get to the closing table, the lender won't be there. I started to see this happen as early as last Thursday. So what do you do? And I'll help you with that too. So why is this important for you guys to understand? Right now, despite the efforts from lobbyists in our industry, they've failed to convince lawmakers that a solution has to be put in place for that middle. We've bailed out the top, we've bailed out the bottom, we tried to freeze everything, we froze everything at the bottom, but how does that trickle up through the broader economy? And this, like I said, despite massive efforts from lobbyists and like trying to influence policymakers, the policymakers have so much to account for right now that they just have to make hard decisions and move forward with something, because they're getting a lot of pressure to do something to help us. So investors in the secondary market, they don't have to buy this paper. They always have. Historically, the Fed's always stepped up and made it comfortable for them by taking these securities. As you can see, from 2008, the Fed started putting mortgage-backed securities on their balance sheet, and we've continued to do that. And we just started to taper those off, but you're about to see another sharp rise in this. I have a lot of faith. The Fed has proven that they're purchasing everything they can. They're throwing as much money at this problem as possible to try to get this done. I expect that they'll come up with something, hopefully in early this week, that will actually help stabilize this, and this session will no longer matter. That's my hope. In case that doesn't happen, this is what I spent my weekend on. So this is a summary matrix that will basically show you 7 creative financing tactics that will help you not only save deals at the table, but get homes on the market, get homes already on the market sold. If you're an investor, this is how you buy if you're afraid to spend your own cash. These are 7 ways that you can buy. So whether you're a realtor, whether you're an investor, this is a matrix that I intend to teach a class on each and every one of these. Obviously, in an hour today, I'm not going to have the time to do this. I would say this is somewhere between 10 and 15 hours of actual instruction at this pace, if I were to teach you all the ins and outs on how to do these. But you can see that I'm thinking outside of the box. These are all things that I have experience with, all ways that I've put deals together. I'm showing you the risk and the benefit for both the buyer and the seller. And I think where we'll go with this is I'll just start to break this down and we'll teach these one at a time. It's in somewhat of an order from the most conventional to least conventional. I think for most of probably your experience levels. So a second mortgage to an interest-free mortgage to owner financing, contract for deeds, assumption or subject to, wraparound mortgages, and then lease with option to purchase. So from the top to the bottom, they get a little bit more complex and a little bit more complicated to understand and execute, but all these can be done by anybody on this call. If I could figure it out as a kid that I'd never sold a house, remember, in 2012, and I've been able to do all of this stuff in a matter of 3 to 6 months. I was capable of doing all of this. Because I couldn't stand in 2012 to look a seller in the eye and say, I can't help you. To me, I held myself accountable. I'm like, well, how professional am I if I don't have a solution for the people who need my help the most? So this is something that just to show you, I'm not here to just present problems. I'm more here to show you some problems so you'll understand why I'm presenting solutions that you don't quite know you might not know you need yet. The 7 things on this will keep most deals alive at the table if you have motivated parties. If you have a motivated seller and a motivated buyer who still want this to close, one of these 7 things should get your deals closed, whether the banks are lending or not, whether the credit standards have tightened or not. If you're an investor, you can leave your powder dry, and you can use these strategies to pick up assets for the next short bit. So what can we do about this? In my opinion, guys, there's a buyer's market, there's a seller's market, and we just invented a brand new one, and it's called the professionals market. So in a buyer's market, the buyer has the market is in their favor. They have the benefit. In a seller's market, they have the benefit. What we're seeing now, I think, is a professionals market. I think you've got nervous consumers, you have nervous homeowners, and you have nervous investors, and you have nervous bankers. And that is a recipe for complacency and people just stalling. And that's what makes me the most nervous, is that there is a potential, and I hope the hell I'm wrong. I hope this doesn't happen. I hope everything breaks loose and this is the best year ever. And that's the sentiment that I'm seeing from a lot of real estate professionals. And I kind of feel bad that mine doesn't match. But if I'm wrong, you'll be better equipped to do creative deals. If I'm right, you'll be one of the top professionals in your market. So if you have buyers, you can advise them to wait, and that's going to build trust. It's not going to pay you. You're not going to get a commission check, but that person will be your client whenever the time is right. Whenever they become a motivated buyer again, you should be the one that they trust the most because you took an advisory role. You can push them into conventional loans if we start to see government loans tighten and you're not getting, if your people no longer qualify, nudge them toward conventional loans. If that's closing up or that's not working, they still can't qualify, we can push them toward owner financing, private mortgages, some of the other creative things that I showed you earlier. If they're really in love with this house, they plan on living there long term, and you can't get it closed because of the lending environment, go negotiate with the seller to kick the closing date out until there's some settlement in the market and more certainty. If the seller won't do that, you can always try to change you try to put an option on the house. Say, listen, we love this house. We're going to give you $500 for an option to purchase that expires August 31st. And that way the house is not going to get away from them. It's a $500 for the privilege of holding that home off the market and controlling it to an extent until things get cleared up to where they can get financed. Your buyers don't have to walk away. If they still want the assets, you need to step up and show them how they can get it. For sellers, especially in the jumbo and especially in the second home markets, when the lending dries up, what happens to listing inventory, and supply and demand is no longer in their favor. And when that happens, you're going to see price corrections. So if you have sellers who really need to sell, if they need to get out, not like, oh, well, if we could sell it, we would, but people who are like, we are moving. My husband got a job transfer. He's starting at a hospital in San Diego next week. Now is the time to be aggressive in how you market. If you don't get these higher priced assets sold now, they're best case scenario, they're going to sit for a while. Worst case scenario, they're going to lose a ton of equity while they sit for a while. This was a situation on Friday, one of the ones that I coached. It was a jumbo loan, an expensive home, and people motivated to act on both sides. And I think, in my opinion, it was in their best interest to write a second mortgage and take a risk on that to protect their equity. If sellers are highly motivated, you can do price reductions daily until you hit the market. This is something that, if someone says, no, we get every dollar counts, but you think that your market's turning and you see this coming, one of the things you can do is list it with a blanket clause in your listing agreement that the price will be dropped X amount until offers are received. Your seller doesn't have to sign any of those offers. If it goes too low, you can advise them that, hey, listen, you don't have to do this. We can stop right here. At any time you can change it, but it's how you can get attention when no other listing is. If they trust you and you understand it, you can sell these assets. You can even advertise these assets with owner financing or creative financing to allow them to lock in their equity now. So if we're going to offer 100% owner financing to a buyer who will give us full price and pay his own closing cost, then we can lock in that price today. If the lending market shuts down and that, like in luxury homes, I'm kind of talking now, but if it's a higher priced asset or a second home, if the lending starts to stifle the market by keeping other buyers out, then we've locked in that price. We don't have to worry about appraisals. The biggest risk is default, but the worst case scenario is you take back a house you already owned. And then there's one of the most unique ideas I've heard this week from, and I put my spin on it. One of my investor friends who's holding a lot of houses, the tenants have been, they can't pay the rent. They've been kind enough to go ahead and vacate because they wanted to do the right thing for him. And he has been going to, there's different websites where you can find traveling medical professionals. I think one is like travelingnurse.com, and you can list your rentals there. The one thing that I've added to his strategy is not only look to rent to traveling healthcare professionals, but put it at a lower rent than usual and ask for 6 months of prepaid rent. That way that they're not going to default after the first month's rent because there's a moratorium on evictions. It's unlikely so what I'm saying is you can tell your sellers to just hold their position and rent homes and rent, like tenant screening is very important here. So that's another option. And I'm going to jump to the Q&A here in just a second, guys. So what I would say is, like I said, we're entering what I'm going to call a professionals market. This is where the people who have the most brain power and creativity and influence will keep the market moving forward. Deals don't have to fall apart at the closing table if the right person's at the closing table. And I hope I can inspire you to be that person. Let's just hope that the Fed steps up today, tomorrow, whenever they need to do to resolve the problems in those secondary markets now, so it doesn't affect our loans. I think if I were in your position right now, the best advice I can give you is talk to your lenders and see what communication is happening inside of their company. Most of the lenders that I talk to that don't own lending companies, they're like, no, it's good. We're taking apps like crazy. But the people who own them are like, yeah, I don't know what I don't know what this looks like by the end of the week. We're hoping on the Fed here. Like, we're hoping they step in. So if your lender doesn't see a problem, that's awesome. Just keep plowing forward, get the deals closed that you have now. If they do see a problem, start to ask questions. Ask them what do they think is coming. What do you think you should advise your clients to do? look at your buyer clients and decide, should they really close in this environment, or do you have different advice to give them? And you should be stepping up, having that conversation with your buyers. Like, don't worry about, a lot of people are cautious to wake sleeping giants. But for me, like if I was expecting someone to give me professional guidance, I would want you to be on the phone with me, telling me what you see and what you think I need to be prepared for. Um, when you show them that you're acting in their best interest, and even when it's not good news, you're telling them, listen, this could come up. We want to put a contingency plan in place for you. Do you feel comfortable with option X, Y, or Z? And I think there's nothing but respect that you could get from that. And the same thing on the seller side. Tell them that, listen, there's the lending industry is facing some headwinds right now, and it's very likely that, based on simple economics, we're taking buyers and sellers out of the marketplace, and we hope that was just going to stabilize things and everything would pause. But unemployment has gone sky high. The government has made some moves that's kind of proving that they believe unemployment is going to be a long-term reality for us. And there's a good chance that you might see your price actually lower, if not now, when everything comes back online. So if I could show you a way, if I could get you a bird in hand right now by being more aggressive and creative, at least you can make an option. It's not up to me, but if I can show you what I see and I can bring you a bird in hand, then you can have a choice. And that's what I would like to do. And if they're okay with that, if they say, nope, I don't know what you're talking about, everything's going to be fine, then you've done what you can. And then you can have a contingency plan of your own for them if you need it. If I'm wrong, then the economy will come back online. Multiple offers will fly like they have been. Asset prices will soar, and everything is going to be great. Worst case scenario is you will at least have thought about some contingency plans for your sellers if that doesn't happen. And next, I will just end this by saying, guys, it's even for me, this has been challenging. Like, there's just so much changing. It's such a dynamic environment. Just when you think one thing is solved, another, it's like the guy that's spinning multiple plates. Just when you get one balance, this one over here starts to wobble. And I'm sure that's how everybody that's associated with the Federal Reserve feels right now. But you've got to renew your vows to really survive and thrive through this. And it's up to you. We're going to do everything we can to make sure you have get the questions you have answered, and give you the tools and the knowledge you need to weather this. But it's really ultimately up to you to stay motivated, keep mindset, and keep moving forward. So I'm going to jump to Q&A, guys. Let me pull this over here. I don't know. Sandra said I was cutting out. I hope that didn't last too long. Bud, good question. I'm going to try to get Bud Thompson on the line with us here. Bud, are you there?
Can you hear me now?
I can hear you now. How are you, sir?
I'm doing well, sir. How are you?
Doing well. So you would ask about, can we do owner financing on probate deals, right?
Well, yeah, from the standpoint of making the first call, second call to these people, how do I address that?
Yeah, so there's different things you can do. The first question you have to ask is, or what you need to find out is, who's on title? Like, how is title held right now? Because if there's a reverse mortgage in place, or if the deceased was the only one on title, then it's gonna have to go through probate until title changes hands. If there is a will, that can be a little bit easier if it says, and especially if there's only a single heir. There's cases where, I'll walk through the scenario. Spouse, if they held title as tenants in the entirety with survivorship, then a lot of times the real estate will just go from spouse A to spouse B outside of probate. Right. In that case, then you can do anything you want. You can do owner financing, lease options, whatever you choose. If it is, let's just say it's husband died, wife got the house, then the wife died, 2 kids are probating the estate. In that case, the title is probably still in the wife's name, and the in order to do a creative financing solution, you need to move the asset to someone else's name and then sign an agreement with them and make them the lender. So you can't necessarily make the estate the note holder, because that doesn't, you have to close that estate out. So you would need to figure out between the two heirs, if one wanted to buy the other out and the other one wanted to do this, or if they wanted to form an LLC and roll the asset into it, and then that LLC can hold the note that the buyer pays. That's one way to do it. So if there was a will and no other heirs, and those two were intended to get the house anyways, then you can get the house quick claim down to those two, or those two, an entity or a land trust that those two are the beneficiaries of, or the members of. And then that entity could write this agreement. They could sell the house with owner financing. And these are not that difficult to do if the courtrooms are open. In some markets, we're going to need court approval to transfer title, and the challenge will become there: how long is the court backlog? So
Yeah.
with the only court date that I've heard with certainty was from Bill Gross in Los Angeles, and I think his next probate hearings were pushed. I believe it was July 14th. So that's where this could be challenging. Even though we can close real estate, we can transfer title. Sometimes we might not be able to do it without court approval. So in those states, we may be at the mercy of the court and the logjam that's facing them right now. So if you think about it, everybody that's getting divorced, that's going to jail, all that stuff's backlogging right now, and the courts are going to have a difficult time clearing that. They've never really had to deal with everything being offline this way, but they are innovating. I think a lot of courts are taking steps to get Zoom court, like virtual courtrooms, in place, and hopefully they'll come up with some other interesting innovations to help move things through more quickly. But there are ways to do it with probate houses. Not everyone is going to work. Like the very first probate that I ever, the story that I tell in Mastery at the beginning, that was husband died, wife was the only heir, and then wife had a massive stroke. Daughter called freaking out, and we ended up doing a lease with option to purchase because she had a power of attorney for her mother. They did proper planning. So as the POA, she was able to sign the lease and the option to purchase, and we were able to get her. I think I handed her $11,000 that day so she could get her mother out of the hospital and into a rehab facility. And that's what was so much pressure for her. She didn't know what to do. She had this, all of her mom's net worth was in a house, and the house was the reason she couldn't get moved to a facility to get her care paid for. So she was, in a catch-22, and I used creative financing to help her out of that one. So in a lot of cases you can do it, but not in all of them, bud.
Thanks, Chad.
Yep. All right. Next up we have Sandra. I have never done a tribal loan. I don't know. Let's talk about it. But I'm going to mute you back out there. Sandra Smith, you're on the air.
Hello there.
How are you?
I'm good. It's a little wild out here, but it's good.
Yeah. So you have a tribal loan and escrow. Tell me more.
Well, it's it is underwritten by the tribe, by the tribe, but it's government backed or government insured. And so I've been checking with my lenders in escrow saying, how are you guys doing? How's your liquidity? All that stuff. And this lender said that, things are getting a little weary, but he thinks he's going to be able to fund it. So I said, well, hurry up. But yeah. I wondered if you knew if the tribal loan fell in that same category as the other loans that basically aren't going to be able to get funding in the end.
Yeah, if they're saying I've actually never done a travel loan. We don't have that many reservations in Virginia, West Virginia, and Hawaii. So I've never actually dealt with that one. But if it's government backed, it's basically, if you look at what I would go Google and look around and look at Fannie Mae, Freddie Mac, Ginnie Mae. Those are pretty much all government loans they are falling under those entities, and you may be able to find some more specific information. I would think any government-backed loan is going to be held to the same standards. So even if it's under a different entity, if there's some other entity for tribal loans, then it's probably the standards will all probably match across the board for government-backed paper. So like credit scores might go to the number I've heard is 680 as the new low credit score, which is as 620 is a pretty normal low for those, I think. So I would expect whatever FHA, VA, USDA standards are probably would also apply to the tribal loans.
Okay, thank you.
Is that a big thing in your market? You do a lot of those?
No, and it's funny because she's a transplant to Washington, and we have tribes, we have reservations all over where I live, but she's actually a transplant. Um, Fortunately, I just sold her house, and she's got $100,000 to work with and a excellent credit score. So hopefully she'll be, in that top tier lender, and we'll be okay. But I'm definitely nervous.
Well, like I said earlier, like that matrix that I showed you, there's a lot of things. She has a lot of options in this environment with $100,000 down payment and good credit. We can hand a credit report to a private seller and cut the bank out completely, and structure it with as low or an even lower interest rate, maybe no interest, because sellers are gonna be nervous too, and we can so don't let her feel hopeless.
Okay.
Like, keep her engaged. Obviously you want to close this one if you can, but if not, it's not the end of the world. Like, it could be an opportunity and hiding.
Excellent. Thank you.
Yep. All right, next, Edwina. My mouse keeps disappearing. There we go. Hey, Edwina. Edwina Potter, you are unmuted on my end, but not on yours.
There we go.
So you ask about court delays. So surprisingly, obviously in states where they have completely locked down, which there seems to be more and more of those coming each day, obviously not a lot's happening there. As I mentioned earlier, Bill Gross kind of he gives us updates from the LA court in our Facebook group. And what he's seeing there is they're actually pushing the trials from last week when he posted that. The next trial date was, I believe, July 14th. So
Wow.
that's going to create a backlog in the states where the courts are heavily involved. We're going to have to, keep our sellers patient and help them in any way we can, and just see how that's handled. I think that courts might be forced to be more efficient. I don't know what that looks like right now. Maybe they will just grant full authority to all executors. I don't know. We don't really have a roadmap for this, but right now it hasn't proven to be a very big problem. I think that as this becomes more and more real to everybody, I think eventually you're going to see more and more states locking down, at the state level, making those decisions, and it will create some problems. But so far it hasn't been that problematic.
Okay, thank you.
Yep. Yeah, good question. Ash is asking about hard money. Hey, Ash, you're unmuted if you want to talk with us. So Ash said, what are your thoughts on the wholesale market? Will the cash buyers be able to raise hard money or private money? I think so. I see hard money lenders right now are actually aggressive. There's a lot of capital on the sidelines. That chart that I showed you where I kind of changed my position in 2016, a lot of other guys did too. So there's a lot of capital. When you go to conventions and expos, like there's so many hard money lenders out there these days compared to just a few years ago. So there's a lot of capital looking for an investment. They're not buying bonds. They're not buying stocks. They're not buying crypto. Unless they're buying gold, then they're going to be looking to write some safe loans. What I'm seeing, like they are tightening down on their LTV standards. So like the best one I've seen in the last 3 or 4 days is a hard money lender. They will do up to 65% of the LTV on the after repair value. So your ARV LTV, I guess. So like if a house was worth $100,000 completely fixed up, they would loan you 65. So if you're buying at the right price, a lot of times that's enough to cover both your acquisition and your rehab. So you wouldn't have to come up with any money. And the reason they're lowering those standards because if they're padding their risk. So if the market, if prices do correct, then you're not going to be upside down on a hard money loan because they don't want the house. They want you to have a successful project and make money, and they want to make a little bit too. So right now what I'm seeing is they are becoming nimble and they are making changes where they feel comfortable lending, but it's not going to look like it did a few weeks ago. There is more risk associated with those loans now. But I don't think they're going to dry up. I think that money is going to rush in and save the day. Like the private money and anyone with cash is going to be very useful to us to keep things moving forward. Yeah, Roger, I remember this story. Let me find you here. Okay, Roger, I think this is Roger Lisi. You're the only guy I know that spells your name that. Roger, you there? He must not have a microphone. So Roger said, probate solution. One sibling wanted her money. Other sibling wanted to stay in the house. Pawnbroker bought the house as a private lender and sold to the one staying and paid off the money. The other sibling paid off the money. So I think I remember, Roger must not have a microphone. I think I remember this. Now? Hey, are you there?
Yeah, can you hear me?
Yeah, I can hear you now.
I had to hit the unmute button.
Can you get a little closer to your microphone?
No, I've got a headset on.
Okay.
With the mic in it.
Yeah. So run us through that deal real quick, just so I have like literally 5 minutes, guys. I'm going to rush through this, but Roger, give us a quick summary. So you made a pawnbroker the lender to cover money or you made them a private lender to cover the money one sibling didn't have, so the other sibling could keep the house, and then they paid it off over time after they got the rest of the inheritance, right?
That's correct.
Okay. Yeah, and you're the one that approached the pawnbroker, right?
Yes.
Yeah. So that's creative thinking at its best, guys. Roger went and found some guy who had a high risk tolerance, who has cash on hand, thinking outside of the box, and he turned him into a private money lender to basically create a bridge loan for one of the heirs who wanted to keep the home but didn't qualify for financing or have the cash right there. So stuff like that.
The probate was still active at that time, and each sibling had a different attorney, and the court appointed a mediator. And I took the deal to the mediator and with a BPO and an updated BPO, and he took it to the judge, and the judge said make it happen. And so we were pretty lucky that there was conflict between the siblings, and both of them got what they wanted.
Well, thank you for that, Roger. All right, guys, I have to go to Mastery here pretty soon, so I'm going to run down these lists. Rhonda Burton asked, where do you find these? Yeah, I guess that means you didn't find the replacement lender on Friday. So I have a friend who owns a lot of prime lending offices, and as of yesterday morning, I don't know if that changed this morning, but as of yesterday in West Virginia, Pennsylvania, where in his footprint, prime lending still had sources for jumbo loans. So if you didn't find a replacement lender on Friday, try to see if there's a prime lending office and around you. They may have access to jumbo loans still, but as I told you, I would get that one closed as quickly as you can. And John, I think we just covered that your question about hard money lenders. What I see hard money lenders doing so far is they're lowering their LTV, and I think their rates are staying about the same. What you could expect is lower LTVs, higher rates. However, the private money market is so competitive right now. There's just so much cash out there that they can't loan. Like I've seen hard money come down as low as 1.8%. Or excuse me, 1 point origination and 8% interest, just so to be clear. But it's a very competitive space, so that should keep rates reasonable. But you probably are going to see LTVs compress just because they have to, they're taking the risk. And that's all the questions I have in the comments. Let me go to our Q&A box and we'll try to clear it. Sorry, guys, questions come in more than one way. Kevin asked, does the stimulus apply to self-employed people as well? As far as we know, yes. I don't know all the details, and I'm not able to find exactly where to point you to actually get those details. I think we're all waiting curiously. Jim asked if we could email this. So Jim, it's going to be posted in our Facebook groups. You can yes. So Kat will actually link to it in the show notes. The creative financing matrix. Michael, same answer. The creative financing matrix that I made will be shared with the show notes. Dave Gwynn, 2 minutes or less. I'm going to come find you. All right, Dave, you're unmuted on your side. You there, Dave? So you're asking for strategies for acquisition or for capital raising?
Yeah, to raise private money for doing deals or setting up loans to help others get deals closed. And
with your marketing machine in place, I think the energy you would spend raising capital, I think you could take that same energy and get yourself into some subject twos, owner finance deals. And I think it's going to serve you a lot better long term to generate your own cash out of those deals. As far as raising private money, anyone who took their position out of the stock market 3 weeks ago, so doctors, dentists, people who had foresight and saw this coming, that rolled to money market, they're going to make awesome lenders right now because there's so much uncertainty in the stock market. And I don't think that, I think we're seeing some rallies and some dead cat bounces, but fools rush in, and a lot of guys know that. And until the market actually bases for a while and stabilizes, and we see an obvious, at least a secular bull market, then a lot of those guys they're not going to step back in. So they're going to be sitting in money market. So talk to your financial advisors. They're not going to suggest that people pull their money out and go risk it with you. They're going to tell them how risky that would be and how they should stay in money market, and they should be dollar cost averaging and buying on the way down, which I think is horrible advice, but it's what a lot of people are getting. So if you can find them independently, anyone who might have, rolled their retirement accounts to money market and it's sitting there as dead money, show them how to get over to Equity Trust, Entrust, Provident Financial, and set up a self-directed IRA, and then loan that money to you through a self-directed IRA. At that point, anytime that they feel like going back into stocks, they can just take that self-directed and rebuy their brokerage position. So you're actually doing them a service by showing them how to get their money outside of that fence so it can go play in a bigger field. And then at any time they can corral it back in and buy mutual funds or ETFs or whether they were invested in. So I would say find the cash that find the investors that ran to cash, and that's where you can raise capital.
All right, thanks.
Yep. All right, guys. Well, I'm going to go. We've got a class waiting for probate mastery. Thank you guys for being here. I hope this was beneficial. we're kind of improving this on the way. So we'll jump in on Wednesday at 1 o'clock. We'll do another hour, and hopefully the world is a little less chaotic at that point. But we'll try to give you everything we can to manage as this environment continues to shift. So have a great day, and thanks for being here, guys.